Hi, my name is Lily and I'm a data analyst. In this video, I'm going to share with you 5 reasons why I think this is the worst time to invest in an Airbnb. And how I would use those same reasons to choose the best area to buy an investment property right now during the pandemic. My analysis is specific to Sydney and New South Wales in Australia, but I implore you to look at data in your area too. Keep watching to find out more. There's a perception in Australia right now that it's the best time to buy property. Interest rates are at a record low, and the government is trying to remove barriers for home buyers from a few different angles. So if you're borrowing to buy, it's a better time to buy than before. And it's converting to action, with new mortgage lending commitments at a record high at the end of 2020. The majority of this is driven from people buying homes to live in, but there's also an uptick in investment. So how did I come to the conclusion that it's the worst time to invest in Airbnb? There's a few parts to this story. The first is why I think it's so important to cast the net wide when choosing an investment property and look at consistent raw data across as many suburbs as possible. The second is my analysis of this data, and from this, why I think it's a terrible time to invest in an Airbnb for rental return right now. And the third is how I would invest my money instead, using the findings from my analysis. Before we get into it, this is not advice. I'm not an expert on real estate, and I'm in no way qualified to give financial advice. What I'm sharing with you is just my opinions. Please apply your own judgment and do your own research if you're looking to buy a property. And generally in life. Okay, let's get into it. So you might ask, why do we need to look at raw data when there are online tools that already give us great stats and insights on suburbs and properties? And you're right, these tools are great, and the companies that built them invested a lot into collecting data, cleansing, analysing and aggregating it into what you see here. But you need to know what to search for to use these tools. This is useful when you're looking for a home to live in because typically you already know where you want to live and what kind of property you like. Buying as an investment, on the other hand, shouldn't be an emotional decision, and your human biases on what to search for shouldn't be the starting point. As long as an investment property for rental return meets key metrics like occupancy and return on investment, it shouldn't matter whether you like the location or whether you would want to live in it. So if you start with data on a specific suburb or property, it kind of reminds me of this scenario.
Regent Street. Do you want to buy it?
Okay, Lily, quick, think. Regent Street. The probability of landing on it is 2.68%. If there's 4 of us and we play 50 turns each, I can expect someone else to land here 4 times. If I build a hotel, I can charge $1,200 in rent, so for each dollar I invest, I make back $3.94. Is that good? It sounds good. I'd better buy it just in case. Just kidding, my partner doesn't let us play Monopoly because he's a sore loser. But seriously, now imagine you have this data on every property. If we do the same calculation for every property, $3.94 is actually in the lower half of what you can get. What I really want is to land on Vine Street, which is 28 tiles away. Come on, Lucky 7. If I were to approach this like a data analysis project in business, I'd say to effectively gear to an investment goal, like rental return, you'd need to start with broad data to objectively compare as many suburbs as possible, like this. So you can make informed top-down decisions on things like where to buy, whether to rent it out long-term, whether to rent it out short-term like through Airbnb, and what you could charge based on similar properties around. This was the free publicly available data I used. I got Airbnb data from a third party called Inside Airbnb, and they scraped the information that's publicly available on Airbnb for major cities on a monthly basis. I used the data for Sydney from January 2019 to February 2021. I also use these quarterly rent and sales reports from the Australian Bureau of Statistics. The rent report is based on rental bonds that are lodged to the New South Wales government. The latest report was for the quarter ending December 2020. The sales report is based on property sales information lodged to the government. The latest report was for the quarter ending September 2020. In my analysis, I filtered to only apartments to keep it like for like across data sets. It's not a perfect science because we can't see the mix of apartment sizes between areas, and strata properties can sometimes include things like townhouses, but it gives us a consistent starting point. Okay, here are the 5 reasons why I think this is the worst time to invest in an Airbnb. Reason number 1. Not surprisingly, without international travellers, the number of Airbnb bookings and occupancy have decreased significantly across Sydney. Number of reviews for entire apartments took a nosedive from April 2020 onwards, and are at 25% of what they were the year before. This decrease has happened in all but 3 areas which had very low numbers to begin with the biggest decrease happening in the city centre, which would have relied most heavily on international travellers. Comparing 2019 to 2020, only 5% of all listings had an increase in reviews year on year. A third of these only saw an increase of 1 or 2 reviews. Considering the median minimum number of nights a guest could book was 3 nights, 1 or 2 extra bookings likely wasn't a significant increase in revenue for the year. Let's look at the listings which had growth of more than 3 reviews year on year. They only make up 3% of total listings, but some of them seem to be thriving. If I map them out, we can see they're concentrated in the inner city and beach areas. This is in line with what was most marketable about an Airbnb in 2020. Among the most common words in listing descriptions were Bondi, beach, and city, which makes sense if we think about what domestic travellers want for a getaway. So you might say, well, what if I bought in one of these areas? If I'm really lucky, I'll get enough short-term bookings, but if not, I can always rent it out long-term. Which could work, but leads me on to the next reason. Reason number 2. These areas also seem to have an oversupply of long-term rentals, so whether you rent it out short-term or long-term, the odds are stacked against you. Using the quarterly rent report, between December 2019 and December 2020, these are the areas that have had increases in total bonds held and new bonds lodged, and decreases in median weekly rent for apartments. Let's break that down. An increase in total bonds held means there are more apartments available to rent compared to the year before. An increase in new bonds lodged means more people are entering into new leases than the year before. And these 2 factors, coupled with a decrease in rent, indicate there are more apartments available than there are renters, and renters are able to move around to where they can find cheaper rent. So if you invested in Airbnb in one of these areas, you're going to have a lot of competition whether you rent it out short-term or long-term. Reason number 3. Without being able to charge higher premiums through Airbnb bookings, these areas aren't the best investments for rental return right now. Using the quarterly sales report, this is the distribution of median sales prices for apartments in the quarter ending September 2020. Because there were over 200 data points which would have been hard to look at manually, I applied a clustering algorithm to get these nice clean groups of sales prices that are most similar to each other. Plotted out on a map of Sydney, you can see the least expensive to the most expensive suburbs to buy an apartment in. And these are the least expensive to most expensive suburbs to rent an apartment in the quarter ending December 2020. They look very similar because there's an almost perfect correlation between median sale price and median rent of a suburb. The more expensive it is to buy in, the more expensive it is to rent in. Which sounds like a good thing for an investor, but not exactly. If we look at return on investment, the percentage of sale price you could make back from rent in a year, the most expensive suburbs yield the lowest return because they're exponentially more expensive to buy in, but aren't proportionately more expensive to rent in. So if you invested in an apartment in one of these areas right now, it wouldn't be working as hard to make back your investment. Maybe it's always been like this, even before the pandemic. It makes sense that the prices are lower and rental return is higher the further you go out from the city centre. But before the pandemic, Airbnbs in these areas would have been able to increase return by charging higher premiums. What do I mean by this? If we take the nightly price of an Airbnb, times it by 7 to get a weekly price, generally it will be higher than what the property could charge in weekly rent with a long-term tenant. This is the appeal of Airbnb for hosts. Occupancy isn't guaranteed, but when you get bookings, you can charge a lot more. And over the course of a year, you can potentially make more than renting it out long term. This variance in price is what I mean when I say they charge a premium. And every area was and is doing this. So for these areas before the pandemic, if occupancy was high enough, it likely could make the same return, if not higher, as these areas with long-term rentals. But now, with much lower occupancy, that model isn't as likely to work. Reason number 4. Because of these first 3 reasons, these areas are high capital and high risk investments, like putting all your eggs into one basket, even if you intend to fall back on long-term rental. As a pure hypothetical, let's say you bought here in the city centre. The median sale price is $1.3 million, and the median weekly rent is $550. If we assume a 100% occupancy, you could expect rental revenue of $28,000 or a 2.06% return per year. For the same amount of money, you could spread your investment across these 5 suburbs in regional New South Wales that have the highest hypothetical return. Again, assuming 100% occupancy, your rental revenue and return would be more than double. Let's introduce the element of risk. Let's say in your city centre apartment, you can only rent it out for 80% of the year. And let's say for your regional apartments, there are varying levels of occupancy throughout the year. You're better off having the risk spread across multiple properties. Even if all your regional apartments had only 50% occupancy for the year, you're still better off because the rent-to-sale price ratio started in a better position. But that's if you can even afford to invest $1.3 million, because unlike in the game Monopoly, we don't accrue wealth like this.
Oh, hey, take this money for walking past here.
Whoa, thanks! You see that property over there? I can buy like 3 of them now.
Oh, really? You don't need a mortgage?
Nope. Reason number 5. Without international travel, there's no sign of recovery yet. Let's look at this plot of number of reviews by month again. We can see a sharp decrease in April 2020, but then an uptick in December. To verify if this is a trend back up, we can apply a very basic form of time series modelling. If we tell the model every 12 data points is one cycle of a year, it can separate fluctuations due to seasonality versus a longer term trend. There's a clear pattern of seasonality between the months of the year, and the downward trend isn't picking back up. So for now, this uptick looks like a natural function of seasonality, rather than a sign of longer term recovery. You might say of all of this, well, duh. Of course Airbnbs are suffering due to the pandemic. Tell us something we don't know. To that I say, we can reverse engineer these 5 reasons to create a list of criteria for how to choose the best investment property for rental return right now during the pandemic. Like, let's go for areas with low rental vacancy rates. Let's avoid areas with an oversupply of rentals. Let's gear to the metric return on investment. Let's go for low sale price properties and see if we can diversify across multiple properties. And let's lean into the new normal. Using this data I already have for New South Wales, let's sort by return on investment from highest to lowest. As an easy example, we can look at this top postcode, which is 3 suburbs in Albury, about 6 hours out from Sydney. We can see there's only been a slight increase in total apartments available, there's been less movement compared to the year before, and rent has increased 10% year on year. It doesn't look like there's an oversupply of apartments to rent here. We can check rental vacancy rates using this tool. It's been on a downward trend since June 2020 and has stayed at under 1% since, which is low compared to Greater Sydney and Sydney city centre. Okay, so let's see if we can find a property that's on the market right now that could be a good investment in this area. Let's plug in the postcode, include nearby suburbs, filter to apartments only, and sort by lowest price. Let's look at the first one. The asking price is $87,000, and it's written here that the property is currently being leased for $180 per week. So at 100% occupancy, the potential return is 11% per year. Let's look at the next one down. Asking price is $149,000, and they reckon it's currently being leased for $155, but believe it could get $195, which puts potential return at between 5.41% and 6.81%. And here's another one. Asking price is $175,000, and it's currently being leased for $205, so potential return is 6.09%. Okay, so what does all of this mean? Am I saying don't invest in an Airbnb at all? Not categorically, no. But hang on, didn't I start the video with I think this is the
worst time to invest in an
Based on my analysis, it looks like there are lower risk and higher return investment options right now. But there are Airbnbs in Greater Sydney that are making it work and have seen growth during the pandemic. I'm also conscious that my analysis is very top level, and the examples are focused on the extremes of investing in Sydney city centre versus regional New South Wales, and potentially there are areas in between or specific properties that could really work. Another gap is I didn't have Airbnb data on regional New South Wales listings, which may have changed the story. And more broadly, I don't know what this looks like in other cities and even other countries. But I do hope this was helpful in showing you the value of data like this, whether you're an owner, prospective owner, or renter. I highly encourage you to distill what your goals are and look at the data in your area. That last bit is also good life advice. Anyway, that's it for this video. I hope everyone's doing well despite these hard times. Thanks so much for watching. This has been Did Someone Say Data?, where I try to solve problems outside the box with data. If you liked what you saw, please consider subscribing. This is a brand new channel and this is my second video ever, so every little bit of support from you guys will have a huge impact.